So, for those of you who are not new to the channel, you may already have covered some of the content I put out around real estate financing. I dropped a couple of videos that describe, I believe, over 10 different real estate financing options that might be right under most people's noses that they don't realize they can be using to get their real estate investing career started. I've also recently dropped a video, or at least created a video, that talks about the importance of financing for real estate investing and how it's really the cornerstone of any successful real estate deal. No matter what other skill sets you may lack in, if you can figure out financing, you can usually make the rest work. So this video is actually going to quickly touch on the confusion around real estate financing. I'll call it confusion. And the reason I call it confusion is because the majority of the real estate investing, real estate related content on the internet is heavily focused on creative financing. And I am a big proponent of creative financing. I am a big advocate for creative financing because it allows the door to open for a lot more people a lot sooner than they may have if they were to take the traditional route. So I am definitely a proponent of traditional financing. But this video is a little bit more of a criticism or a critique, or at least a challenge around the idea that creative financing is not maybe either the only or should be the primary and sole form of financing, and that banks are the devil and you shouldn't want to get financing with banks. So tune in to the end of the video to get a full perspective on this, because if you're either new or in your earlier stages, or maybe even if you're a senior tenured real estate investor and you run across this, maybe this will just make you think a little bit. This is JP with Blueprint for Prosperity, here to help you increase your network through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. I want you guys to like the video, subscribe to the channel, hit the bell icon. I'm uploading content on a daily basis to help you up-level your finances. Thank you for tuning in. Let's get started. So, creative financing has been in the real estate space for a really long time. And it really took off, arguably in the last few decades or so, as the economy has expanded and more people are participating in the concept of investing in real estate for wealth building. And more financial tools have hit the market in the last couple of decades that have expanded the creative real estate investing financing niche, if you will. Creative financing is going to be pretty much any non-traditional form of financing. When you think about owner financing, when you start thinking about private money, hard money, when you start thinking about these various different funding strategies, you can probably say using, your IRAs, self-directed IRAs will fall in that space. There's just a ton of different options out there that, you can consider as creative financing, using a loan against your 401k, and the list goes on. I've actually done a couple videos on this already, so go back and check those out. Creative financing gives you flexibility, and it cuts the time frame down that it may take you to save up for down payment money or the cash you may need to plug into traditional financing. And it also is usually a faster form of taking down a deal than traditional financing. Real estate investing is a very competitive space. When you are bidding on properties, when you're trying to take down properties, you may not have 30 days to close on a property before somebody else outbids you or takes the property right from under you. You may need something where you can take that deal down in 14 days, 10 days, 7 days. Creative financing literally is essential for this type of real estate deal. It's very important. But creative financing is not the end-all be-all. It's not the mecca. In most cases, creative financing is a short-term fix. It's literally putting a Band-Aid on a gunshot wound. The reality of it is, creative financing is usually expensive and not desirable terms, maybe with the exception of owner financing and the exception of private money. In either one of those two deals, you can structure terms that will be, favorable, potentially less expensive than the average creative real estate financing option, and, terms that can be agreeable for all parties. But in most cases, You think hard money and all these other different options that are out there, these non-QM type loans and things of that nature, they usually are pretty expensive, meaning that there's going to be more points and fees and a higher interest rate. And the terms on average aren't as long. Now, this is starting to change. The industry's evolving. You're starting to see more 30-year fixed loan options on real estate investments like buy and hold, for instance. But, these are newer products that are coming out and they're still, typically more expensive. So where am I going with this? What's the focus? I am really, really big and I really advocate for the concept of finishing out your financing through banks and credit unions. No matter how you try to slice it, once you've taken that deal down, you've used your creative financing strategy, you got yourself in the door, you secured the property, you rehabbed it, you got to rent it, whatever your play is on that property. What you're going to want to do from that point on is maximize the earning potential of that property. And it's not usually easy to do that with other creative financing options. Again, private money, owner financing, depending on the circumstances, you can maybe get pretty close. And usually it might be good enough for you to stay in that arena. And this is what a lot of real estate investors do. They promote private money, they promote owner financing because they're able to structure the deal where there's still enough in it to get the return that they're looking for. That doesn't mean it's necessarily still the most attractive financing option. And a lot of these real estate investors don't usually have their documentation and their finances structured and their business structured in a way that allows them to go to banks and credit unions and take advantage of the mecca of financing. Yes, they're harder. Yes, there's more yellow and red tape. Yes, there's these tighter criterias and boxes to fit into. But if you can get approved for bank level or credit union level financing on your investment properties, you're going to get for sure the best terms, usually the least amount of fees, and you're going to get the best interest rates almost hands down, because you have to think private money and most owner financing options are going to be looking to get a better return on the money, especially if they're holding it long term, than they can get in the general market. So in order for that to work and for it to be attractive enough for them, if the bank's willing to take 4 or 5%, then that private money lender is most likely going to be looking for nearly double that or more in order for it to be worth it for them. So yes, there's speed, there's flexibility, there's more breathing room for the type of deals you can do. But over the course of that loan, over the course of that financing term, you may be paying nearly double the interest rate on that property. And even if there's room for you to make the profit you may have been looking for, you're still leaving 2, 3, 4, 5, 6% in interest every single year on that return. And that's a lot of money over time. So the point of this is to try to get those of you who are new to the space that haven't gotten started but are thinking about getting started, have gotten started, but you're just a deal or two in and you haven't gotten baked into a certain process yet. And those of you who may be experienced real estate investors and, maybe a little stubborn that may be catching this content, you need to think about this. Get your paperwork in order, get your business structure in order, get your financing in order for yourself, for you to be able to get the best financing options available. You can get so much better terms with most local banks and credit unions in almost any market than you're likely going to get from any other creative financing source over the life of that property. Now, again, in the takedown process, totally get it. But once you start to bridge off into 10, 20, and 30-year terms, in most cases, you can't beat local credit unions and banks. And this is where you need to be structuring yourself early on to get to once the deal has been secured and taken down and it's more attractive for banks to lend on. Something to think about, food for thought. I want you guys to comment down below. Let me know your thoughts on this. Let me know if you have more questions. I'm going to be putting out more content around this, but I want to get more feedback from you guys so I'll know where I can serve you better. This is JP from Blueprint for Prosperity. Thank y'all for tuning in. I want y'all to stay focused, stay in motion. I'll see y'all soon.